You've been doing everything right. Every single month, like clockwork, you set aside a little money. You buy your index fund. You don't panic when the market drops. You don't get greedy when it spikes. You are the disciplined investor that every finance book tells you to be. And honestly, that's genuinely impressive. Most people can't even do that. But here's the thing nobody tells you. And this is the part that's going to sting a little. There comes a specific moment in your investing life where dollar cost averaging quietly stops being your greatest weapon and starts becoming your biggest limitation. And most people, they never see it coming. They just keep buying, month after month, feeling productive, feeling disciplined, while their portfolio silently underperforms what it could have been. So today, we're going to find that exact moment. And once you see it, you cannot unsee it. Okay, so let's start with our guy. Meet Marcus. Marcus is 26. He just landed his first real job, and his buddy told him about dollar cost averaging. The idea is beautifully simple. Instead of trying to time the market, you just invest a fixed amount every single month, no matter what the market is doing. Market up, you buy. Market down, you buy. You're basically taking human emotion completely out of the equation. And look, for Marcus at 26, this is perfect. This is exactly what he should be doing. A study from Vanguard found that DCA helps new investors stay consistent and avoid the catastrophic mistake of panic selling, which, by the way, costs the average retail investor about 1.5% in returns every single year, just from bad timing decisions alone. So DCA is working. Marcus is building wealth. He feels good. We love Marcus. Fast forward 10 years. Marcus is now 36. He's been consistent. His portfolio has grown. But here's where the story gets interesting and a little uncomfortable. Marcus's portfolio is now worth, let's say, $180,000, and every month he's still investing his $500. Feels disciplined, right? Here's the thing though, that $500 monthly contribution now represents less than 1/3 of 1% of his total portfolio. The math has fundamentally changed underneath him, and he hasn't noticed. When Marcus first started, his monthly contributions were actually moving the needle. They were meaningfully lowering his average cost per share. But now, the market's daily fluctuation on his $180,000 portfolio is swinging more money in a single afternoon than his entire monthly contribution. His $500 is basically a rounding error. This is the first moment DCA starts losing its power, and almost nobody talks about it. Think of it like this. Imagine you're steering a kayak. When you're just starting out, every single paddle stroke matters. Each one genuinely changes your direction. That's DCA in your early years. Every contribution is a meaningful stroke. But now, picture Marcus trying to steer a cruise ship with that same kayak paddle. He's paddling just as hard, just as consistently, putting in just as much effort, and the ship barely moves. The tool didn't get worse. The situation outgrew the tool. And look, this is where most finance content stops. They just say DCA is great, keep going, consistency is king. But that's only half the truth. And honestly, leaving out the other half is doing you a disservice. Because here's the surprising reveal. The real limitation of dollar cost averaging isn't about market conditions. It's not about bull markets or bear markets. It's about something called contribution significance, the ratio of your new money coming in versus the money already sitting in your portfolio. And once that ratio drops below a certain threshold, DCA's core benefit, lowering your average cost basis over time, becomes statistically negligible. Researchers at the Journal of Financial Planning found that once your ongoing contributions fall below roughly 2 to 3% of your total portfolio value, the variance reduction benefit of DCA is essentially gone. You're going through the motions of a strategy that's already done its job. So what does that actually mean for you? It means the goal of DCA was never meant to be forever. It was meant to build you to a point where your actual portfolio allocation strategy takes over as the primary driver of your wealth. And this brings us to the second moment DCA stops working, and this one surprises people even more. Let's talk about rising markets, specifically long, extended bull markets. Here's a fact that sounds almost backwards when you first hear it. In a consistently rising market, a lump sum investment outperforms dollar cost, averaging roughly 68% of the time. That stat comes directly from a Vanguard research paper. 68%. Now that doesn't mean you should time the market. Please, don't do that. But what it does mean is that if you're sitting on a pile of uninvested cash, an inheritance, a bonus, proceeds from selling a house, and you're slowly dripping it in over 12 months because you've been told DCA is always the safe play, you are statistically likely to be leaving money on the table. The logic actually makes perfect sense when you think about it. If markets trend upward over time, which historically they do, then every month you wait to be fully invested is a month your money isn't compounding at full capacity. You're paying an emotional comfort tax, and that tax has a real dollar amount. So